So great. Thank you so much for joining me, Karen Rands, for this Compassionate Capitalist podcast and video today. As you know, if you've been listening to any of my videos or my podcasts in the past, you know, one of our big things, and if you're new to it, one of our big purposes of this show is to propel this concept of getting more people to diversify their portfolio and include investing in entrepreneurs, the private capital into the private companies of entrepreneurs, and gaining confidence in doing that. That's why I wrote the book as a primer, Inside Secrets to Angel Investing. If you're not watching the video, I just pointed to my book. And I wrote that as a primer. And then within that, I always, you know, I try to get people to adjust to a new way of thinking, of not investing based off of emotion, but this process of due diligence. And I just did a podcast, you know, a couple weeks ago about due diligence and this due diligence tool. And it's always this thing. And a lot of times you have angel investors that say, well, the reason why you want to be in an angel investor group is because due diligence is easier because you got more people sitting around the table with different experiences. And it's still this sort of mamby kind of, I was going to say mamby-pamby, but it's, you know, it's a squishy way of going about making a decision about an investment when you can, you know, really, I mean, every investment has a level of risk in it. The perception of angel investing and venture capital investing is that it's one of the riskiest, but it doesn't really have to be that way. And so the reason why you're listening today is because my guest, Joe Milam of AngelSpan, has broken the code, so to speak. He is bringing Wall Street principles and disciplines in the way that they analyze stock picks and the way hedge funds end up always making a return. There's always, you know, these certain ones, there's a methodology to it. And he's going to talk about how he's using that through AngelSpan to the benefit of venture funds, to the benefit of companies, and the benefit of angel investors, you know, entrepreneurs that are raising capital. Because one of the things that I always coach entrepreneurs on is this thing called transparency. And there's a certain amount of expectation that public companies have transparencies because they're required by law as a public company, and private companies don't necessarily, they're not obligated to it. So the burden's on the investor to get that information out. But it's in the interest of the entrepreneurs to be transparent, but sometimes that can be a challenge. So reason why Joe is an expert on this, and he has both insights of the capital markets of Wall Street and the behaviors of venture capital and angel investors, because he sat at both of those tables. He sat at both sides of those tables. For probably 30 years, he spent time as a financial manager, analyzing public markets, working with the wealthiest people on how to grow their asset portfolios and their wealth. And then he's been an angel investor. He's participated in angel investor groups, all of those things. And he'll tell us more, but I want to say hello, Joe. Welcome to the Compassionate Capitalist podcast.
Thank you for having me. And that was a very generous introduction. So, yeah.
Absolutely. So Joe and I have been connected for a while through LinkedIn. And then we had the opportunity when I went to Austin, I guess it's been over a year now, to sit down and talk. And he was telling me, although he was very, very excited about the time. And I was like, wow, that's really ambitious. And he is, you know, as you'll learn in listening to him on this show, there is no mountain that's too high for Joe to climb. And he really, truly is onto something that can change the marketplace for the better. So let's get into it, because here's well, let me ask you first, is there anything you want to fill in the gaps about your background and your experience that to set the stage for what we're going to talk about?
Yeah, I'll just give a little bit of clarity, some finer points for clarity's sake for some of your listeners or viewers that are familiar with my old industry, because it's, and where I did it, which I think is really important and contributes to context. But I was a fee-based registered investment advisor. We were an old school firm in that we actually did our own securities research and built portfolios for wealthy folks with individual securities. So it's a little bit of the old school way of managing money.
Okay.
I joined a firm in 1990 that was owned by a European bank, and then ended up taking the business over in 93 when my predecessor died of cancer. So long story short, the irony is we happen to be located right there at 3000 Sand Hill in the early 90s before the internet became commercialized and all hell broke loose in the angel and venture world. So as an old school money manager, as it's called, we had a front row seat to the modern era of the very things we're talking about. And it was really that background and that position, location, and timing that really informs a lot of what we'll be discussing today.
Okay, very good. Great. All right, so now one of the things that I talk about in my book, you know, and I guess when I do the next version, I'm going to have to talk about it differently because I know new information now. But, you know, we always talk about, you know, this average of 10 companies. And in my book, I advise people that, you know, when you figure out there's a process through the resource portal that we have that says how much capital do you have to invest, if you're going to, you know, and therefore you've got to, you know, this stage of company based on the amount of capital you have and so on and so forth. But don't even get started if you're not going to do at least 5 companies and have the cash on hand to do, or plan to how you have the cash over a period of time to do at least 5. It's really 10, but I didn't want to scare people off, so I used 5. But the scenario that we always talk about with 10, and it's kind of been derived from the venture capital market, is that out of 10 investments, you're going to have 3 that go belly up, 3 that are going to be kind of like base hits, 3 that will do pretty darn good, but, you know, and then the 1 that's going to hit it out of the park could make it all work. And the caveat on that is everybody's trying to pick the 1, but clearly that they have this as their example of what to expect, nobody knows how to pick the 1. And so it's all about diversification and this idea of due diligence. And I always say, well, you know, particularly when companies are raising capital, if you got seasoned investors, they've lost money on stuff because of this scenario. And so they always have this checklist of, I'm never doing that again. Oh, how come I didn't ask about this? Oh, you know, these kind of things. And then some of the stuff you think like, why didn't you ask about that basic stuff? And so when we talked the other day, you gave me some insight about venture capital that I want you to share with the audience now about why that model is so not even just old school, but just, you know, it's so obsolete, and why people adhere to it is just really amazing, particularly with what you're working on. Uh-oh, we lost your sound. There we go.
Yeah, I'm happy to. And if the background noise is too loud, let me know here, okay? If
Okay.
it's disruptive. Yeah, again, and a lot of investors or venture capitalists claim they like more data, but when the data on their own industry is presented to them, they kind of look the other way, because it's, to use Al Gore's famous phrase, it's an inconvenient truth.
Yeah.
That the venture model itself is tired. It's 60 years old, and it's largely unchanged. There's a lovely book that came out last July, written by the professor of entrepreneurship at Harvard's Business School, Tom Nicholas, called VC, An American History. And he gives a wonderful account of the history of the venture industry. He gives a wonderful context. And he speaks to this very fact on page 311, that there's been remarkably little innovation in the very industry that purports to fund innovation.
Yeah.
So this is not an opinion. This is a learned observation from a historian of the industry, Tom Nicholas. And so, yeah, you can beg the question why, and we can probably spend a whole nother podcast on that topic as to why it hasn't changed much. But the reality is it hasn't, and it needs to. Back 60 years ago, when entrepreneurship was largely concentrated in Boston and Silicon Valley, a small cadre of funds, many of which they knew each other, were involved with a small number of startups located in those cities. And that old model was sufficient for that very cottage industry back then. Unfortunately, again, the structure and the process of identifying and doing due diligence and architecting venture portfolios is largely unchanged. Now, there is some innovation, which we'll talk about. People have been trying to bring some innovation to it. And again, the industry is really reluctant to admit that their model is 60 years old and tired. So the innovation is coming slow. We're bringing innovation to the model itself. And directionally, we're bringing the tools and proven tactics that has been long since practiced in the public markets to manage risk, to build and architect and manage portfolios so you have confidence you're going to deliver risk-adjusted returns for your investors, what's called alpha. And so that's really the thesis behind how we're bringing innovation directionally. And we're using long since proven tools and tactics. So we're not creating new models. And we're leveraging some relatively new research and data to plug in on sort of the thesis itself, such as what is proper diversification of a venture fund? You know, if you think the work that's for years been accepted as sort of the de facto standard in the public markets is, if you had a portfolio of 15 to 20 companies, all of which were uncorrelated, that's enough diversification of individual holdings in a publicly traded portfolio.
Right, meaning like they're in different industries, so they don't impact each other.
That's right. The movement of one isn't highly correlated to the movement of another one. They need to be uncorrelated in their industries and their behavior patterns. That is proper diversification, because the goal of diversification is to manage what is called non-systematic risk, company-specific risk.
Yeah. Okay. Mm-hmm.
That's called non-systematic risk. Now that's in the public markets. Now you hear a lot of conversations in the private markets that if you've got 20 to 30 private securities in your venture portfolio, you're okay in your diversification, which doesn't even intuitively make sense, given that it's a lot riskier asset class. And that's only marginally more diversification. And so often these VC firms themselves have a thesis that they're investing around, which means most of the companies are highly correlated around that thesis.
Yeah, right.
They're just not properly diversified
Right.
at a fundamental core. Now, what's shocking is, and there's lots of great research, 500 startups did some great research on this, by the way, and it was been confirmed by two other organizations. One is Circle Up, who's also, by the way, I want to give them a shout out because they're doing some really good research and bringing WallStreet-like disciplines, principally in their thesis is around CPG, or consumer products goods startups. But they're philosophically identical to what we're going to be speaking to today. Proper diversification. For a seed stage portfolio, that should have between 100 and 200 companies. Mathematically, that's been proven through very sophisticated Monte Carlo simulations using actual return data to optimize on the diversification without diluting the impact that a really good winner would have on the overall returns of the portfolio. So it's that balancing act of enough diversification without too much.
Yeah. So I want to touch on that right now, and I want to make sure that folks listening that as you come through this, and we're going to talk about this how it applies to venture funds and individual investors and how they can benefit from this. But the whole goal of this conversation today, and the goal of what AngelSpan is doing, is to learn how to deploy capital with confidence. Without, there is a certain level, there will always be a certain level of fear of losing it, but there's a way to avoid the big mistake using the kind of things that Joe's talking about. And to that, the thing that a lot of times when you think about the traditional flow of capital, right, there's the seed stage and then there's a Series A, and usually VCs come in after that. And VCs, a lot of times their philosophy is, oh, we got this $100 million fund, so we can only manage X number of companies in that. So therefore we can only put 5 to 10 million. We have to do 10 million into it. Therefore they have to be this amount of valuation, and so on and so forth, because they feel like they have to manage into the day-to-day operations. So they're naturally further up the food chain, if you will, and all this risk gets associated. And the reason why there's so much more capital deployed at angel stage versus VC stage, as far as number of companies, is because they kind of all go in their lanes. And what Joe's going to talk about with their approach, it really upends that whole philosophy and takes that risk out of how you invest in the seed stage and then build your portfolio to do this mitigating risk piece of it that he's going to talk about. So I wanted to set the stage on that and kind of remind people that, because sometimes I'll talk to entrepreneurs and they'll be like, oh, I just need a VC. And it's like, oh, well, you're too early to get a VC, because a VC is going to invest this amount of money, and that's more than what your whole company is worth right now, right? So roll into this philosophy. And also, Austin is a real hotbed of venture, of angel activity and entrepreneur startup that, it's a very dynamic ecosystem there, but you're also very tightly coupled with, you mentioned 500 startups and these other ones, and I think Y Combinator and these other things that you've been involved with. So the mentality out in Silicon Valley. And as you go into that, I want you to address this idea of, the celebrity VCs, right? Where there's some of them, part of the panache is that they know how to pick them, right? And that's why people put their money with them. And it's sometimes they just kind of got lucky. They kind of got into the right thing at the right time, because who knew that Uber would have been what Uber is or whatever, at that time versus something else. It's like, oh, they invested in company A and not company B, and company A happened to win, right? And so there's so many of those intangibles, and I wonder how much that keeps the industry where it is versus embracing some of the innovation and best practices.
Well, let's talk about that. Yeah, I think you've opened up that can of worms with that last question, and I think it's an important point for your listeners, because the phrase you use is celebrities, the celebrity culture, and I think that entrepreneurs and others, when they hear somebody's a VC, they instantly give them far more legitimacy or credit, or presume they have far more investment experience and acumen than they do. The venture industry itself, even though the National Venture Capital Association, the organizing body of the industry, it's been around since '73. The VC industry itself still is an apprenticeship. It's like a guild, an apprenticeship. It's not a profession. And what I mean by that is there are no professional standards, no formal training, no formal industry-provided certifications, curriculum to show you how to even know what non-systematic risk is and how to manage it. What are the levels of diversification? How do you manage the number one risk of investing in this asset class? Number one, and if you ask most VCs, they wouldn't know it or would admit they know it. And that is simply timing. Everything else is perfect, and something like COVID shows up.
Right.
Or the founder of a company who did all this great research on got caught for sexual harassment. Or divorce or death. So these are all that's called systematic risk. Timing risk is the number one thing that defines the success or failure of an individual company's outcomes and the asset class itself. Just like in the public markets, you could have built a perfect portfolio of stocks in late February, and a month later, your portfolio got crushed. Right?
Right. Mm-hmm. You
could have done perfect research, perfect diversification, and your returns got crushed. Why? Because the markets got collapsed because of an exogenous event. So that's an issue that's critical, and VCs aren't trained to know that or to care about that.
Or to have a fallback on a contingency strategy, right?
No, there's a lot of, let's just call them perverse incentives to spend as much money as quickly as they can so they can hurry up and go raise their next fund. That's a large model. So for your listeners, do not think of a VC as being more experienced than you are or more capable than you are. And another way to, when you think of one VC, you know one VC, because they're all so different. And the way I visualize them in my own mind is they're like schools of fish. And if they're a seed stage VC firm or a micro VC fund, they're going to be a seed stage. Those are smaller fish.
Yeah.
Right? And if they're later stage, they might be like a big school of bluefin tuna. Right? Bigger VC firms, later stage, because those fish have to eat bigger fish to survive. Or the small fish, the small VCs can write smaller checks on earlier stage deals. But just like those schools of fish, they oftentimes all move together. There's not a lot of independent thought going on amongst VCs because so many of them co-invest with somebody else that they're presuming has more experience and has done better due diligence on this company than they have.
Yeah.
Those assumptions.
Well, I remember early on when I was in this space, Guy Kawasaki came into Atlanta and had a speech that he gave. I think it was at one of the MIT forums. And he said, he was talking kind of reflectively on the .com. And he said that fear of missing out drives a lot of the VC investments. And they go, oh, that guy that VC down the road, they invested in a pet supply thing online. So let's go find one that we can invest in because it must be a good sector because they did it. So therefore we should do it. And it really has nothing to do with the metrics
That's
of
right.
the company and
That's
what
right.
their revenue model is going to be or what, or is it right or wrong and all that stuff. So let's get into this idea, and it kind of folds into due diligence piece, right? And the traditional way, because there's they got incorporation documents, they got a financial sheet, they got a balance sheet, they've got employee agreements, they got, there's little pieces of paper and things like that. They got an IP, a patent applied for, a patent pending, these kind of things. And you described it so perfectly the other day about comparing it to, building a company with building a house or a building. So, so
Yeah.
share that, please.
Yeah, I think you bring up an important point that, and I like to, my mind thinks in pictures, so I'll try and speak a little bit in pictures or metaphors, is that businesses are almost like cars, right? You got to have the tires, the engine, the transmission, the brakes, the roof, the windows, all those sorts of pieces. And that's like having your corporation papers done and your employee documents in place and all those sort of organizational infrastructure components. Money is like the gas, right? And the engine and the torque of the engine and the velocity of the forward movement of the business is like what gear they're in, almost like what stage of the startup life cycle they're in. So again, in terms of, and just like a car, that's sort of like a business, but to build that business is not unlike building a building. You've got to build foundational work first, get your corporation done, get your term sheets, your legals done properly, get your book set up properly, get some good outside counsel to make sure that doesn't get screwed up and you can't hide anything, right? That's the absence of transparency and all those sorts of things is what allows for bad behavior to materialize. And each stage of those are important value creation milestones, even though they're not reflected in income, revenue, expense, stuff like that. They're just salaried expenses oftentimes and vendor expenses. But they're still converting investor cash to value inside this construct of this idea that will eventually become a building or a business. And that business then, as it's building its pieces, it's sort of adding both gears and cylinders to the engine, right? Early stage, seed stage, you got one gear, you're trying to get a little bit of forward momentum. Not even very quick, you're just trying to get it to move forward. And then once you get a little bit of cash, you prove that you're actually able to deliver something that somebody was willing to pay for, right? Then you want to add some more cylinders to that engine, build a bigger gas tank, add a couple more gears by raising more money so you can move forward faster with more velocity and more girth, more mass, if you will. So these are sort of the metaphors, but each of those stages are absolutely important stages. For an investor, to make sure that you are going to minimize your chances of that car never completely getting built or never moving forward, you want to manage risk. Don't think of how fast that car is eventually going to become. It's going to be a Ferrari and it's going to go 200 miles an hour and I'm going to make a ton of money off of it. What a really silly assumption. You don't even know who's going to be driving that car. That CEO is rarely the CEO that's going to be driving it if it ever gets to that point. So you're making so many emotional assumptions, wishful thinking, greed, fear of missing out, whatever you want to call it. They're generally emotion-driven rationalizations for writing too big a check too soon in that life cycle of that company.
Yeah.
It's just.
It goes to that term. I remember the first time I heard the term dry powder. I was like, dry powder? And it's like, oh yeah, that's the money that the VCs and angel investors should do it too. They always say, keep back in order to invest in the ones that look like they're going to make it, right?
Yeah.
In that portfolio or stuff, right? And so I always thought, well, that goes to that whole 10 company model, right? And so your approach uses this idea that just like when you're building, there's certain steps along the way that you can measure the progress and turn that into a quantitative value and a qualitative value that says, the things that kind of where due diligence ends, they got a checkbox that they got this document or this thing, and they got this team and he's got that experience, or he's got, this market, or this is their competitors, this is the size of the market, blah, 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 all that kind of stuff that are kind of like the standards of what you evaluate a company on when they're first kind of getting started. But it's really what happens after that is whether your investment's going to tank or not. Those kind of things are kind of, it's sort of like, it's the checklist. It's just a checklist. It doesn't really, it's not a predictor truly of where they're going to go. So if you like the idea, you like the passion, and this comes back to what compassionate capitalism is. If you like the passion of that entrepreneur, you love that, you like it, oh my God, I really can't believe nobody else thought of that product. It totally makes sense. And so there's that emotional side of it, but the capitalist side of you says, I'm going to check these boxes and I got this. And then you're kind of like, all right, cross your fingers. Let's hope, it's rolling dice. Let's hope that this thing works. And your process is a little bit different. It takes it to a whole nother level of, providing analytics to be able to know where do you go from there. And even within the context, like I'm fascinated with the fact, and I've seen some of this with artificial intelligence things, but they didn't have the history that you have to be able to create that risk model that says these are the scores and the things that will work because we have this history of what we know what has worked.
Well, one of the best metaphors for, or parallels, I should say, is that whole concept of Moneyball. Because if you understand how that evolved, it was the old baseball scouting infrastructure where those in the field scouts who were able to convince the major league team owners to pay their salary because they know how to spot a good deal. Yeah. And they need out in the field because they've got contacts and they've got a Rolodex and they got a network of people out there helping them find those hot deals of baseball prospects. And notwithstanding the historical track record of that scouting system being really bad, right, getting them to the teams to sign a high school pitcher to an ungodly dollar amount because you don't want to lose this one because your competitor's going to get them, fear of missing out. Yep. And those outcomes are just consistently wasted dollars, where Moneyball comes in and says, wait a second here. Don't trust the optics or those perverse incentives of people who think they can pick winners.
Right.
Use data and take a portfolio approach to the team. Assemble a portfolio of players that's going to optimize the win-loss record per dollar spent to assemble the team. ROI.
Right.
What a concept, right? And that's really the concept. So now if you take out baseball scout and put in venture capitalist, it's almost identical. The perverse incentive.
Good example.
Are the investors, the LPs. We know how to spot deals. I've got a Rolodex. I got people out there. I'm connected to the network. And trust me with your money because I'm going to spend it well. Notwithstanding the track record and the data. And so when you take a half step back and as an investor are willing to acknowledge the fact that you can't pick winners, that's a hard thing to admit because it's a lot of fun to think you can. It's really good for the ego and it's fun to get in there and ask those questions and try and forecast what the future might look like and then place some bets on green and red and black. Which of these companies might really have an impact on the future. But the reality is that doesn't result in good investment outcomes. So if you want to gamble, go for it. It's fun. But if you want to be serious about it, first you've got to manage risk. Risk oftentimes of your own decision-making process. It's called decision risk. It's one of the biggest risks in consistently delivering investment results.
Right.
Some of your listeners, I think you've spoken, are some high-calibered CEOs or retired CEOs and the like. Well, if they had a pension plan, they had consultants that would go out and find money managers to manage those pension plans. And the rigors that those consultants went through to hire the money managers of the retirees' pension plan for those companies was unbelievable. Mm-hmm. And diversified across styles. Each one of those money managers had broadly diversified strategies with track records, risk management mechanisms in place. That's how serious money is managed. And what we're suggesting is you can, as an individual, start deploying some of those basic blocking and tackling things from a risk management perspective first. And the number one thing is to require evidence of transparency from any startup you're going to spend any time with. Full stop. Full stop. Don't invest in any company that can't give you 3 monthly updates from the last 3 months on what's going on inside the business. It is one of the most powerful risk management tactics any investor can make in this asset class.
Yeah. Well, I'm going to flip over to a chart that you have in a presentation. If you got, and if any people that are listening in the show notes, There's a link to some presentations, some videos that explain a lot of this in more detail than the time we have here to cover it. And also the presentation, just a couple of charts that I'm going to show here. And this one is that idea of transparency and the kind of reports that you use that show. And then I'm going to flip as you're talking to the one that shows the building your portfolio, so you can tag team on those that show this is how you go. I want them to see these reports you're talking about that are transparency and what you do that helps an investor decide, do we do the next investment? How do we go about doing that? Okay. So
what does proper transparency look like?
Yes. Right. And it is, I have so many companies that I've worked with over the years that they couldn't raise that next round or go before they went to the VC and interim round with angels because they had not been transparent. If you don't, investors are very tolerant if you let them know what your obstacles are, what your opportunities are, what your milestones and successes and things like that. They, as long as you're telling them what you're doing, they will stay with you through the process because they're familiar that this is the way it goes. So, all right. So this is the first one, right? So this is your proper transparency. Can you see that?
Yeah. Okay. Those are the components of proper transparency, and the three main things that are the components are the bright cadence. And well recognized that once you're outside of an accelerator, which oftentimes they ask you to report weekly for their internal mentor network. But once you leave an accelerator and you think you've got enough momentum to maybe go out and find some seed, then monthly updates are absolutely critical. Less than that is not enough. More than that is probably overkill for potential investors and other stakeholders. You're trying to just keep their attention and crowd out all the other things that might be talking to them, and that's going to piss them off. It's too much. Once you certainly take money from somebody, you of course want to report how you've invested it, and that's what the quarterly reports represent. The communication of the financial outcome of the prior quarter to your investors and your board. The content's critical because, again, this isn't a newsletter. This isn't just a puff piece with social media pictures and everybody wearing their t-shirt and feeling good about themselves on stage. This is talking about what went on inside the business.
Right.
Team, product, market, and operations are the foundations of any business, and you've got to build and hit milestones and all those at all the stages, addressing the things that are relevant and necessary on each one of those areas at each of the natural organic stages. And then context, which is where a lot of entrepreneurs, even if they're doing it, get it wrong because they end up writing way too much. They get so excited that they're comfortable doing it, then they end up writing tombs, and no one's going to read all that.
Right.
Now, the dirty little secret of this, the science behind communication theory and newsletters, is that if you get somebody to open up a communication like this, you've got their mind for about 3.5 minutes. And they're going to remember about 20% of what they read. And you can't presume they read the whole thing, by the way. So they're going to remember about 20% of what they read for about 5 minutes. That's the science. Now, what does linger is the impression that's left behind.
Sure. Is it an upside or is it a downside? Is it good stuff or down stuff, right? And are they trending up or down and whatnot?
If you want to optimize that thumbs up, consistent cadence, balanced scorecard of the activities going on, succinct and crisp in the writing style, respect their time and mental bandwidth. That's what optimizes that impression that's left behind, that thumbs up impression.
Yeah. And so one of the things that I always tell companies, one of the companies I worked with for a long time, and they were consistently able to raise money from pretty much the same group of investors till they got all the way through the process because everybody didn't want to be diluted anymore. So they all just kind of stayed in on it, was because he did a monthly report. He did a weekly snapshot, like really short. This is, they carried over. Last week, I told you we were going to be meeting with this customer. This is what happened. Boom, like 5 bullet points. Right. And then he did a monthly thing. And because he was so, and you know what? He had been a former stock guy as well. And knew about the importance of transparency reports, right? And so it was amazing how they just kind of kept in, and every time they go, no, don't go out to VCs yet. we want to keep staying in and get you through this, because he was pivoting his business model and getting more, validation from customers, and he was doing all the right stuff, and they didn't care that it was taking him longer to get to this, milestone revenue, right? So
no, there's a sort of a poster child for this, what you just described here in Austin. Actually, his name's Rob Neville, and it's the company eventually went public called Savara Pharmaceuticals. Mm-hmm. He raised something on the order of $60 million. I think that's the number, from angel investors.
Wow.
For like 5-6 rounds, because he was unbelievably good at communicating monthly. Mm-hmm. Mm-hmm. And everybody said it. Rob was the best. He is the poster child for what you described. So anyway, the question really is, why don't more entrepreneurs do it? That's really the issue.
Well, that's the thing. It takes time. And they feel like, oh, well, they're not really going to read it. They think they need to over communicate instead of just having some kind of a standard operating thing. And of course, your tool, that's what you do. You provide this information, you provide this as a service, an affordable service for entrepreneurs to be able to do that. So let's flip over and talk about like the decision process in a seed stage. And so those building blocks, if you will, of what we talked about earlier, and then how how a VC would use your program and your system for this to be able to make this mitigated risk growth of a portfolio. Okay, so let's go.
Well, that's a big leap, and let me give a little context, because you just went from IR to how we support VC funds. So,
well, the strategy, Joe, because the strategy that you have in the way that you're doing this, I think is, if once investors understood this, even if they're individual investors, they could apply this and have the companies that they're investing in use as part of their condition of investing, they use your service, but they would have the comfort level of knowing when they're going to reinvest into the portfolio that they're building. So I know, clearly VCs, they truly have a big portfolio of potentially 100 companies or whatever, but
most of them don't.
Right.
So yeah, I guess let me put some context to that then. Yes, what we've built are the tools to help both entrepreneurs and investors be more successful. Entrepreneurs, to help them be more successful, they need to communicate properly. Most of them know how to do it. So we established AngelSpan as a WallStreet-like investor relations service. It's not a do-it-yourself dashboard. There's a lot of coaching, a lot of hand-holding. We do most of the curation. We do a lot of the heavy lifting so that an entrepreneur can just spend the time building the business and have confidence or getting this communication process right.
Right.
Now, what that allows us to do, because of the information that we are helping them report on, is that we actually have created, as a result of having access to inside information on our clients, is we created WallStreet-like research and analytics that are then able to empower the investor side if they're expecting and requiring AngelSpan on their portfolio companies, whether you're an active individual investor or you're running a syndicate or a broader venture fund. As long as you're having access and requiring AngelSpan, then we avail these analytics for those investors for free. We want them to be better. We want them to be successful, which includes better risk management tactics as they're building properly diversified portfolios, but also having the analytics to inform those follow-on investment rounds, which is the illustration you were just bringing up. Because this is really how to optimize on an outcome of a venture fund. Pragmatically, can everybody build a portfolio of 100 to 200? Not likely, unless you use a lot of the other infrastructure tools we actually have built. So we have built tools to facilitate that. But that really means you're going to be a professional VC. But for an individual, no. 100 is an aspiration, but it's also an order of magnitude reference point. It's certainly better than more than 5, right?
Yeah, right.
If you 25, that would be vastly better than 5. Is it optimal at 100 to 200? No, but it's vastly better than 5, especially if you have data on all 25 and you are committed to doing follow-on funding on the superior subset of those 25 as the 10 to 15 of those 25 really start performing well enough to earn follow-on funding, because eventually you should write bigger checks in those follow-on rounds than you did in the checks you wrote on the original 25.
Okay, so let me ask you within this context, is it says, because a lot of times the follow-on says, okay, they've got this many eyeballs or they've got this much revenue and therefore they can grow faster, we give them more money, and revenue becomes the criteria or some metrics like that. And what you're looking at with the way you do the analytics, or like not you personally, but the way your systems,
Our framework,
your framework does the analytics, it's looking at a whole lot of other factors for longevity and performance than just revenue, right?
Yeah, I mean, if you, again, I always go back to Wall Street, and forgive me, but if there are a group of investors on Wall Street that only invest in high growth companies that have accelerating revenue, that is their only investment criteria. Okay. Now that is a style of investing that is very episodic in its success. High growth companies. That was the go-go 90s.
Yeah.
Janus 20 was an example of that out of Denver. They ran a mutual fund called Janus 20. They had 20 companies, the fastest revenue growing companies, publicly traded tech stocks. And by God, that portfolio screamed for about 2 years. And then it imploded and was down like 85% in the crash. Right? So very narrowly defined investment criteria, like you just described, can work for oftentimes very narrowly defined windows in time. The methodology that we have deployed to analyze startups is ubiquitous across business model, stage of the startup life cycle, and these are proven analytics to be able to view objectively with and create longitudinal data to analyze startups. Now that's never been available on startups because everybody's got their own little secret sauce of investing or due diligence criteria. This is a standardized way, just like the Wall Street tools. There's standardized ways to evaluate income statements and balance sheets. Calculate EBITDA, for example. So this is a very robust way. Now, if you want to apply these analytics in a thematic approach to venture, that would work just fine. Okay, so we're not saying those are wrong. I can certainly challenge these episodic thesis investing as saying you're likely going to underperform for your investors, as happens, we've seen happen time and time again in the public markets. But having said that, the analytics, yes, we have make sure that you're tracking all the relevant value creation drivers across each stage of the startup lifecycle. And then how you want to focus in your thesis of investing, that would be up to the investor, yeah.
Well, and part of your developing these models, these systems to do this, you were able to test them and use and build upon the historic data of companies that have succeeded and failed, right?
Yeah. Yeah, the original architect of this model, and again, it's not our model. It's really important to keep objectivity each component of our model. And because it's not our model, I don't have any pride of authorship. Okay, it's really important. But the model itself was built by Gordon Bell and working with Coopers & Lybrand, the old accounting firm that got absorbed into one of the big four, and a gal named Heidi Mason, who Gordon met years and years ago when he was at Digital Equipment Corp. He was the inventor of the mini computer, actually. And he taught computer science at Carnegie Mellon and put that program on the map. I mean, he's a rock star. If you look up his Wikipedia, I would encourage you to put his Wikipedia in your notes. He's a fascinating guy. But he went out to Silicon Valley and found there's a lot of good startups, a lot of good technologists trying to start companies, but they didn't know how to build a business to successfully monetize this good idea. So he worked with Coopers & Lybrand and Heidi and said, there's got to be a way to architect a roadmap, a sequence of steps, such that if the entrepreneur does these milestones and does them completely across all the relevant components of the business, team, product, market, and operations, and hits the right milestones in the right sequence, at the end of this natural sequence of milestones, you'll have a self-sustaining business. So if you're struggling with any of those, accomplishing of those milestones, you know what you got to focus on. And you shouldn't move forward on other areas until you get that solved. Otherwise, you're like starting to build one side of a building and not completing building the other side, right?
Yeah.
Putting things in their proper sequence. So yeah, he had that architected, back-tested over thousands of companies. It was the de facto standard research framework on the old guard venture firms like Mayfield Fund and IVP and some of the old guard guys, because Gordon built it in the 80s. He's still alive today. He lives in San Francisco. He's an investor in AngelSpan. We have the Bell Mason diagnostic in the inner workings. So that's what structures our monthly updates and gives us the framework to create these analytics, as we score them across the Bell Mason every month. And that's the longitudinal analytics that we avail to people that want to manage their venture activity with rigor, with a risk management approach first.
Mm-hmm. It's the golden goose that lays the golden eggs.
Repeatedly.
Yeah. So let's look at this. Let's go back to that chart now and look at this idea of how, people talk about diversifying a portfolio, and it's like, oh, you're going to take 25% out and you're going to put it into private equity or into angels. But you're talking, so when you have decided this is your chunk of funds, so to describe this chart, and for the folks that aren't able to see the visual on it, again, it's in the link to the thing, and it is page 9 out of that presentation. It's called Data Supported Funding Strategy. So go ahead.
Yeah, and I'll try and describe it for the listeners as well. But what we're looking at is the body of it is illustrating the optimal way to deploy capital in venture in startups over time, knowing that you're going to invest in multiple rounds. You're not just going to be one and done in any one company. Okay. Now the base portfolio would and on the right hand side of this, you'll see some dials, and it has in the bottom portfolio, it shows 10%, which indicates 10% should be roughly how much of your total dollars you're able to spend over a full funding cycle. 10% should go in your original portfolio. Now, a properly diversified base portfolio, we call it, should have between 100 and 200 companies. So if you're going to invest $100,000 over 3 rounds, then 10% of that's 10 grand. How are you going to put 10 grand in 100 companies? You really can't do it. You got to buy an ETF. That's why people have ETFs in the public markets. Small amounts of money get the benefits of diversification.
Right.
This is an aspirational strategy. Everybody can use components of this to implement their own, but it really is, if your returns are suboptimal, you could probably spot as to why somewhere within this illustration, what you didn't follow. Yeah. And that first portfolio should follow some theme or thesis. Now, that's what shows on the left-hand side of this illustration, shows what's motivating the assembly of these companies. It could be around an industry you like. It could be female entrepreneurs or African-American entrepreneurs or entrepreneurs in your home city because you want to support the entrepreneurial activity in your city. That's a thesis all by itself, local entrepreneurship. So you need to have something around your thesis. It's really important because you need to have a reference point. You need to have structure to why you're going to invest in this company versus that company. Now, how you assemble that portfolio is literally making sure that who makes its way into that portfolio is not anybody you think is going to be a huge financial outcome. You're already fooling yourself.
Right.
You should let any of those companies enter that portfolio that have been de-risked, meaning they don't have the character traits of bad deals. That have, because there's a big pile of failed startups that you can analyze and see what was the common traits amongst this huge pile of failed startups. And one could even suggest WeWork is on its way to a failed startup. Even though they tried to go public and they've raised a lot of money, they're dying. They're dying slowly, but they're dying. Theranos is another poster child for this. $900 million in multiple rounds, and she's going to jail because she was not transparent. Rupert Murdoch put $125 million in her last round and didn't ask for audited financials. That was a stupid investment decision.
Isn't it amazing that you think people, just because they got all this money, they're so smart, and you look on the outside looking in. I mean, it is hindsight 2020, but it's like, come on, really?
No. That is an easy thing to say. That was really, because what? He didn't want to miss out. It was the cool kids syndicate. Mm-hmm. Everybody was doing it. The Wallens were doing it, and everybody was doing it. Yeah. And she was a glamorous blonde dame from Stanford, and all the optics.
Well, that's where all these unicorns, people get this pile on and they don't really have, a lot of them don't have that business model that will sustain and actually create a value proposition in a public market. And there's no way to get an exit out of a unicorn except to go public.
Pretty much, that's correct. So long story short, there's lots of lessons on what not to do. And that's how you build that first portfolio. And one of the key first steps, as we mentioned, is expect transparency. There's research in the materials that are also Karen's going to provide that shows some great research on if you simply just invested in companies that were showing evidence of transparency. They don't have to be using AngelSpan. We're the best at it, and we have this companion analytics to go with it.
Yeah.
But that's going to be a great portfolio to be just from a starting point around your thesis.
Yeah. And so then
Now,
once you've got you're doing this because you're not static. So, I mean,
no,
maybe year one, but a lot of times, you know, with this is really for a venture fund itself, but for somebody that, you know, is building, you know, bringing in new companies into their portfolio each year, they have to adopt. And when I talk about the book, you have to adopt the thing that says, this is how much over this period of time. And then you're going to go into whether it's year two, but it's the next phase of when do these companies need money that you're going to approach it the
yeah,
way you're talking about.
yeah, and you want to make sure that the companies that are in that base portfolio, however many you're able to get in there over a reasonable period of time, a year, 2 years, whatever, is that they remain transparent. That's one of your criteria for any investing round, not just the first one, but follow on as well. And they've earned that money by hitting milestones. Now, again, our platform does provide those objective analytics. But as Karen spoke of earlier, there was a guy who was able to raise a lot of money because he was really transparent about hitting milestones and communicating the process. So you make sure that that transparency expectation is part of each of your funding criteria. But by having transparency, you could also start looking at the portfolio and make your follow-on investment decisions driven by data, not by emotions. Always with evidence of transparency at each step. And that second portfolio is roughly 60% of your first portfolio, but it will be 2.5 times your original investment. Now, the reason that you make bigger bets sequentially as the portfolio gets more concentrated, that's right out of poker betting. It's called the Kelly criterion.
Yeah.
It's a mathematical truism to optimize the return on all the capital deployed in a world of imperfect information and uncertain outcomes. Poker. How do you optimize on all your bets, knowing that you're not going to just place a few bets and then walk away from the table? It's called the Kelly criterion. So once you start getting an information advantage, i.e. transparency from companies and they're performing, you start making bigger bets. And then you just do that again as they're going after roughly their B round. And that's where your big dollars are invested in a concentrated portfolio that will result in be about 20% of that original portfolio. But it's the best 20. And best is defined over time with data. And now you can have confidence to place the biggest bet there because you now have an information advantage. And you've had the timing risk largely mitigated. The number one indicator of success or failure is timing. And because these are still performing, as evidenced by the transparency in the data, you've now shown you've managed timing risk. And you've maintained diversification at each step. Now, again, optimal diversification would be between 100 and 200 at the base portfolio, your seed round, if you will, between 60 and 120 at the A round, and between 30 and 60 at the B round. That's optimal. Pragmatically, that's hard to do right now unless you had a huge population of startups all using AngelSpan, which we don't have yet. We will soon.
Okay. So I see we're kind of rounding the end here of people's potential for listening.
Yeah,
And
sure.
so, you know, okay, so any things that you want to share as sort of that oh, I should have said this, or
Yeah, I mean, the notes I put down, we just literally did sort of hit the sort of summary of best practices. Diversification, expect transparency, diversification, dollar cost average, which sequentially higher bets. That is how you can optimize and deploy capital with confidence. The one piece that we haven't talked about, and it's an interesting subject that I've been lecturing for over 20 years on these tax laws around angel investing. And I've lectured CPAs, big family offices, Wilson Sonsini's office, both here and in San Francisco. Very few people know about these laws. They exist and they're available for taxable angel investors, whether you invest directly or through a fund. And they're called qualified small business stock tax incentives under two different sections of the tax code, section 1244 and 1202. So QSBS, qualified small business stock, under sections 1244 and 1202. 1244 is that law that says if you invest in a seed stage round where you're part of the first $1 million in a startup and it fails, you actually can deduct your loss against ordinary income. Ordinary income tax rates are a lot higher than the capital gains rates. Because if you take a capital loss, all you're doing is offsetting capital gains that you might have from selling real estate or stocks. And those gains would have only been taxed at 20%. But if you can write it off directly against your ordinary income, you're now only losing 60 cents on the dollar for a taxable investor at federal rates. You've just capped your downside. Risk management. All right, critical. So if I were an investor in startups, I would also make sure that they're QSBS qualified, which is not hard. Most startups, certainly the startups and most of their advisors don't know about it.
Yeah, is that like a form they fill out with their state or at the federal level, or?
No, the very basic criteria is this. The company itself has to be a C Corp. LLCs don't count. And when you invest, you need to invest in an actual equity term sheet, not a safe note. Stock. Convertible preferred, the old school term sheet, the basic convertible preferred term sheet. If it's a debt instrument, which is what a note is, it doesn't qualify.
So convertible notes don't qualify if that's the first investment.
If some safe notes I've heard attorneys putting, this is a QSBS qualified safe security. Okay, you can do that. But that means it's not a note. It's actually basically a safe preferred stock. You're just not putting a valuation on it. You're simply leaving the valuation off and waiting for the next priced round to define the valuation of that convertible preferred stock. That's all.
Yeah. Well, and also, you know, most states, a lot of states also have tax incentives for if you invest, if that idea that you did, what you talked about before, your thesis is local investments,
yeah,
local companies. There's like state of Georgia has,
there's a variety
of them. It's double digits for, you know, we have our entertainment tax, but this is straight up equity, not real estate, you know, not certain kinds of industries, not the things that qualify for our entertainment tax credits. And then they get that investment taxable, a credit, a percentage of the what they've invested to be applied against earned income taxes for the next 2 years or something like that.
Yeah, every state's got its own sort of incentives, economic development agency type incentives. These are specific at the federal level. They've been around, 1244 has been around since 1958.
Yeah, you're right. I've talked about it, and not that many people know about it, or that it's that easy to do it, or that's the restrictions to do it.
It's really easy. It's not hard to do. It's with a little bit of knowledge, it can be taken care of right up front, and then you don't have to worry about it. The other tax law that is a companion law, QSBS under Section 1202, that was passed in 93, and that one has been updated as late as 2015. But what it says is, if, again, I'm a taxable investor and I invest in a startup, whether I'm in the seed round or even later rounds, and when I invest to the time there's a successful exit, if it takes more than 5 years, then I, as a taxable investor, pay zero taxes on the first $10 million of profits.
Wow.
Period. That also qualifies for the founders of those companies as well. There's a lot of founders that pay taxes on their exit proceeds because their lawyers and accountants didn't know about 1244 or 1202. Founder shares qualify for 1202. If they started it and it took 7 years to eventually got an exit, they wouldn't, and that's per shareholder. Every shareholder of a company has that $10 million max or 10 times your cost basis, whichever is greater actually. So if you put $2 million into a startup and it gets a huge exit, you've got $20 million of tax-free profits. 10 times your cost basis or 10 million, whichever is higher.
So in those scenarios, so say somebody raised a friends and family round, and then they go out to raise their first outside round, and again, assuming that they are, let's go back to talking about it. Assuming that they are doing it these ways, is there anything prohibiting them from being able to execute that if they didn't start that way because they started as an LLC and they did their convertible note and that kind of thing, and the next round they do it as they converted to a C Corp, they're doing this preferred convertible, and so the ones that are in that particular round, not this other round, can potentially participate in that kind of a tax break?
Well, again, there's two laws here we're talking about. 1244 is what de-risks the earliest investment into the company. And that,
so it's that's the first 1 million. That's right.
That's the first 1 million. So under your scenario, If it was an LLC and it raised $250,000 as an LLC from friends and family, then they convert to a C Corp and raise another $2 million. Because they had already raised $250,000 of outside money. The next $750,000 qualifies for 1244 of that $2 million raise.
Okay.
All right. Now let's take, so that's 1244. You have to be a C Corp at the time of investment, and it's only for the first $1 million. So if they raised $1.5 million as an LLC, then nobody gets 1244 coverage.
Okay.
All the time. And that's bad legal advice and bad tax advice. Period. There's no excuse for it. Especially for those early investors, they got screwed. I've worked with a CPA who did the modeling that says, wait a second, if you take the operating losses that flow through the LLC model to the founders who don't need them, they're not making any money, by the way. And founders own most of the company, so they capture most of the NOLs through that LLC structure. And they don't need the write-offs. They're not making any money, right? That's always the justification. Well, the operating losses flow through the investors. Yeah, but most of them go to the founders, and they're not making any money. They don't need them.
Right,
Okay.
because they're the largest shareholders. So
they don't need them. It's bad advice. And if you literally model an LLC versus a C Corp, because the net operating losses get retained inside a C Corp that shelters future profits. So once they turn cash flow positive, those NOLs that were carried forward, you now have tax-free cash flow because it's sheltered by your carry forward NOLs. So again, there is no justification for the advice entrepreneurs get. If they could qualify for a QSBS, they should do it so that the earliest investors get the 1244 risk mitigation. Now, back to your question. If that company converts from a LLC to a C Corp and raises money, those original investors that were in that convertible note that convert to at the C Corp conversion, their clock starts ticking right then for that tax-free profit window of 5 years. So that becomes the date that the clock starts, and they have to hold it 5 years to get the tax-free profits. It doesn't go from when they originally invested in the LLC safe note, but when it converted to the C Corp.
Okay. Wow, that was a great golden nugget there at the end for everybody. So
it's really valuable. And
yep.
You can go back to your taxes. You could probably go capture you probably paid too much in taxes on your gains and losses on your angel investing just by bringing up QSBS to your CPA. And watch their face, because most of them don't know about the law. I've embarrassed a lot of CPAs on this.
Wow. Okay. Well, gosh, I think this has been an exciting conversation. I love this. I'm an economist. And so bring in something where you've got data and analytics that you can look at, because there is a certain predictableness of, if you meet certain criteria, it's like, why not? It's so logical. So
it's like Moneyball.
Mm-hmm.
Nobody thought that would be true, and yet all of a sudden, guess what? Of course it is, because it's data driven.
Yeah.
Once you get off of an old model that's largely driven by somebody's perceived ability to pick winners, and you get to data driven outcomes and take a portfolio approach and see it, then everybody goes, of course you got to do it that way. And that's, we're in that cusp right now in the venture model of moving off of the old model. So
yeah. All right. So those folks listening in right now, if you're in a fund or you're one of those investors that may not have enough liquidity to be able to create your own portfolio, and you find an angel fund or a venture fund that you want to be a part of, get them to make that a criteria that they need to be using these kind of analytics and this kind of approach in the fund that you're doing, and ask, or just keep knocking on the door till you have them, or
don't invest.
Get to know Joe, and he'll tell you who's using the tool, right? Because it's free for the angel and the funds to use it.
Yeah.
So, all right, go to AngelSpan.com, and it's just like it's spelled, sounds, ANGELSPAN.com. And Joe's contact information on LinkedIn is through there. Is that the best way for people to reach you? Or you got an intake form on that as well.
Yeah.
And then there's the videos and things that we're going to provide. So
yep.
Thank you very much for taking the time to come and share all this information with my audience. And thank you very much. Onwards and upwards, Joe.
Happy to help. Thank you for having me.
Good going forward, and I'm going to be incorporating your tools into what I do as well. So Folks, stay tuned if you're listening to the podcast, because there's some additional information that will play at the end of this. So thanks.